Hey guys, hope you are all having a great day so far. It's been a while since I made a video, I believe 2 weeks, and even longer since we really talked about AMC. As you guys know, I always been a huge fan of this company and I adore theaters, and I don't think they are going away anytime soon, and I also think AMC won't disappear, but I do believe there is a lot of really questionable decisions being made by the AMC board, and I think there could potentially be even more dangers ahead for AMC shareholders. This is not me trying to spread fear or anything, but rather trying to engage in a civil discussion about what I think lies ahead for AMC as we know it. Today we are going to take a deep dive into Adam Aron, talk about a potential filing for Chapter 11 bankruptcy, debt restructuring and the path ahead for this company, because as much as I dreaded making this video knowing full well what it means for me in the eyes of many, I have always believed that being 100% transparent and honest with you is the only way to be. I haven't been bullish about AMC's price action since mid-2022 when I began to question the need for APE units, and today's video is certainly going to ruffle some feathers. As always, before we begin, I highly encourage you to come check out my Discord. In fact, if you have some questions or need to talk about your AMC investment, I more than welcome you in. On that Discord we offer trading alerts for penny stocks, options and futures, along sporting a hefty section of educational material free for you to access. All of this is available to you with the click of the link in the video description and pinned comment down below. With that said, let's get started. AMC is struggling a lot. Theaters continue to see weakness in their recovery, and though progress has been consistently growing, the pace by which it has been growing is what is concerning. This is incredibly frustrating for us, as it must be even more frustrating for the board members. And it is this very frustration, mixed in with other challenges we will talk about in a moment, that have forced AMC to announce a new $250 million at the market offering. AMC has once again decided to dilute its stock, which now traded under $3 in the stock market, because, according to them, and I am quoting here, the offering is being conducted to enhance our liquidity in light of the low first quarter box office, resulting in part as previously disclosed from the Writers Guild of America strike and the Screen Actors Guild American Federation of Television and Radio Artists strike that occurred during 2023. Increased seasonal working capital requirements, and the resulting cash burn we have experienced. This latest offering is simply the latest in a batch of non-stop offerings, given that their last one was just a few months ago during December when AMC announced it would be offering $350 million at the money as well, which caused them to have to issue another 16 million shares in exchange for the debt due in 2026. This is something I have seen coming for years now. Something I have been very vocal in warning you guys it would happen since August of 2023, and something that I will warn you once again will continue happening in the future. But before I tell you why, which of course many of you already know the reason, we must first look at the company itself. Because the recovery for AMC is so slow, the company is in a tight position. It must find a way to both fund its operations while simultaneously financing their debt. Given the fact that ticket admissions and popcorn isn't yielding enough revenue, AMC has found a critical and stupendous way to circumvent that predicament by simply tapping into its own shareholders and diluting at their expense. In particular, the proceeds of this latest AMC equity raise of $250 million is meant to repay debt. Looking at the SEC filings, AMC stands to have a total of $10.86 billion in total liabilities, of which an astounding $8.6 billion are related to financial debt and leases. When you start crunching some numbers and subtract the total worth of the assets they have against the total liabilities they have, AMC stands at a deficit of $1.9 billion. This is using the latest SEC filing for fiscal year 2023, by the way. So let's go back to what AMC said about its latest offering. They seem to place blame as the actors and writers strike, which did push back a lot of movies' production timelines and releases, to be fair. However, I think even without that strike, AMC would have still made an offering regardless. Many analysts believe that the reason AMC cannot recover is because of enduring challenges prompted by competition from streaming services. Now, I don't really think this is a fair analysis, mostly because it fails to adequately explain the entire problem. You see, the real issue at heart lies with the fact that movies have become incredibly costly to make. Whereas once having a budget of $100 million for a project was deemed a really expensive project, we have seen these costs balloon so much that now a big movie costs anywhere between $200 million to $400 million after production and market costs are accounted for. As a result of this, studios have become much more reliant on shelling out soulless experiences in theaters, movies that aren't unique but rather follow a proven formula, because the investment has to be as risk-averse as possible. This has driven away a lot of people away from theaters and movies in general, given the quality of those products has tanked. Movies are not, for the most part of course, what they used to be, and consumers are voting with their wallets. When you factor in the fact that theaters have become so expensive, with a single ticket going for $13 to $20 and a normal concession stand price of popcorn, soda and a piece of candy being $30, it really becomes a serious decision that people have to make. Spending $50 or more for 2 to 3 hours of entertainment when you can watch that movie at home really puts things in perspective. I will argue that there are some things changing, however. Over the years, I have seen higher releases of smaller budget films come out and perform extraordinarily well. The last Godzilla film made in Japan had a budget of less than $15 million and had a box office performance of more than $100 million, and that's taking into account limited marketing budget constraints and a very limited showing as well. These movies are the future of cinema because they solve a lot of the issues that studios have. Because the budgets are smaller, studios aren't interfering with the decision-making process and allow for the creators more room to experiment, leading to more authentic experiences that drive people to theaters. Yes, streaming will still be there, but when some of these movies are as successful as they are, people routinely show they would rather watch sequels on the big screen. Remember that a lot of the movies that have come out during the last 2 to 3 years were filmed during the lockdowns of 2020 and 2021. The budgets of those movies blew up due to all the delays and restrictions imposed by laws. Disney itself has stated they acknowledge the fact that budgets have grown too much, and I believe over time we will see them addressing that as well. I am sure all other major studios are in the same position. This is why I have been so vocal about AMC needing to form their own small production company. Making small films would drive audiences to theaters. It could help alleviate those seasons of the year where there's not a lot of big movies on the big screens and help boost revenue. If they can find success in some of them, they could even franchise them and put those movies in their own streaming platform as well as renting them out to competing ones like Netflix. AMC has a really good opportunity to start fixing a lot of the problems they're in. So yeah, streaming does pose challenges to AMC, but the problem is a bit more complex and has to do with the quality output of the movies coming out that has driven audiences to not want to spend premium prices to watch them. As a result of this, I think the way AMC sort of addresses the challenge is by defaulting to tapping into shareholders to help dilute and raise the cash they don't get at concession stands. AMC will continue to do offerings it is no longer a viable option, at which point I expect them to file for Chapter 11 bankruptcy. I think that AMC can survive as a business by simply refinancing their insane debt. They have a lot of debt maturing in the next couple of years, and stand with a long-term debt of $4.6 billion. These offerings are raising between $200 to $350 million each. Assuming they continue to do so while the price of AMC shares doesn't continue going down, which it will by the way, it would take them about 4 to 6 years to raise enough cash to pay all that long-term debt, which is not viable. Remember, the market cap of AMC tumbles every time they dilute, and AMC will likely have to do another share split to increase the price of their shares, given AMC could literally trade underneath $1 by the end of the year, a literal penny stock. I want to be fair, Adam Aron did recently talk about AMC's financial woes, and in particular, about bankruptcy. In an interview with The Hollywood Reporter, when Adam Aron was asked about whether restructuring is on the table, he said no. He explained that it is inconceivable that AMC would have to restructure like Regal Cinemas did and have to file for Chapter 11. He went on to explain that AMC has enough cash on hand to get through 2024, and Adam believes that 2025 and 2026 will be much better at the box office. Once those earnings improve, everything else will too. He reiterated that he cannot foresee a scenario where they do not have enough cash to make it through 2024. I do agree with the fact that 2025 and 2026 look to be much stronger in terms of the movie slates coming out, which will likely result in better revenue for AMC, but I am not all that convinced by Adam Aron, and I am not all that confident in their ability to really grow business enough to not have to rely on dilutive efforts to make ends meet. Again, the liabilities AMC has exceed their assets, and their recovery is not growing enough to really make any significant improvement. If AMC's debt maturity was far dated into 2030 or later, I would be much more bullish, but remember guys, AMC's first debt wall is $3.1 billion in 2026. That's a lot of money they have to raise and hold cash. Obviously trends won't change for no reason, and because people won't go to theaters all that much in 2024, at least according to the predictions of AMC themselves, That gives them more than enough justification to fall back on offerings. AMC still has a large pool of investors, and though the number is nowhere near as big as it was back in 2021, there are many people that continue to buy and hold AMC, enough to give incentive to AMC to tap into them as much as possible. The problem with this plan is that it's not infinite, and if all they're being able to raise with dilution has fallen down to $250 million, I have reason to believe potential future dilutions won't be greater than that, and run the risk of being significantly less than that. AMC has about $800 billion sitting cash on hand, right now close to mid-2024. As I said, they need to have $3.1 billion cash to pay that debt in 2023, which means if the upcoming dilutive efforts pay less, AMC will have to restructure that debt as there will be no real path towards being able to pay that debt. There will be no other cheap trick to tap to make cash, and that puts investors at great peril. Again, this is not me trying to scare anyone. This is me pointing to a logical and rational financial concern that each and every AMC investor needs to face, because the danger is there that AMC's share price could fall to zero. I go to theaters maybe 20 times a year. I spend a lot of money there. I want AMC to succeed, and I do believe they have the capability to make it long term, but their survival is not necessarily par with AMC's shareholders' well-being. This company could be restructured and not recover, to the point shares are taken off the market once and for all. In my opinion, we need to closely monitor how much money AMC makes diluting in the upcoming offerings to really determine how well they can continue squeezing money out of shareholders to survive. That combined with quarterly earnings reports will show us which path AMC will take, either defaulting to filing for a Chapter 11 bankruptcy or somehow being able to raise all that debt. Let me know your thoughts down in the comments below. I really want to hear your opinion. It's okay to disagree with me, just explain to me why. I am currently working on a GameStop video. To be honest, I won't lie to you, their last earnings report was absolute trash. The company's sales went down dramatically, and with a lack of forward guidance along with the fact that the sales will continue to weaken, GameStop is in a very weird spot. They have a ton of cash and little expenses, but they also don't have a healthy revenue pipe, so I will explain to you on the next video where I see the company going. With that said, thank you for watching this video through its end. Have an amazing rest of your day. See you on the next one. To the moon.